Before 30-year loans, the town pooled savings to buy your house. Families brought nickels to the association, got stamps in a passbook, and earned the right to borrow against shares. But how did these homegrown clubs quietly shape the modern mortgage system we know today? 10. Passbooks stamped every week kept people on track. Every deposit was marked with a fresh ink stamp in a little passbook, the same way ration books or train tickets tracked value. These stamps weren't decorative. They were proof that a family was inching closer to home ownership. A worker earning $15 a week might drop 25 cents into the association. Small, yes, but with compound discipline, those coins built equity over years. By the 1920s, more than 12,000 building and loan associations across America relied on these passbooks as their backbone. The psychology mattered. You didn't just save. You saw the ink grow, page by page, like a diary of sacrifice. Members knew if they skipped too many weeks, their neighbors would notice at meetings. It added both pride and pressure. Children sometimes carried the coins to the counter, turning saving into a family ritual. Unlike faceless bank ledgers, this system was personal, tactile, and impossible to ignore. It's strange to think today's digital banking hides this visual progress. But back then, a single missing stamp could haunt a family, while a full page brought celebrations at home. These books weren't just paper. They were ladders to the American dream. Next came the rule that borrowing wasn't instant. It had to be earned. 9. Saving shares slowly unlocked the right to borrow. Membership wasn't a free ticket to a loan. You had to prove yourself by buying into the system, literally. A family scraped together enough to purchase shares in their local building and loan, usually $1 a week, sometimes more if wages allowed. Each share accumulated value over months and years, showing steady commitment. Only after demonstrating loyalty through these deposits could a member request a mortgage loan. By 1930, nearly 12 million Americans held shares in these associations, pooling billions of dollars in local capital. The math was simple but strict. If you wanted to borrow $1,000, you might need to hold 10 or 20 shares as collateral. This requirement filtered out risky borrowers while teaching households to think of saving and borrowing as two sides of the same coin. It also created an unusual sense of fairness. The neighbor applying for a loan wasn't just taking money. They were borrowing against their own demonstrated savings, plus the group's trust. Some associations even drew lots or rotated turns for who received loans first, making access feel communal, not corporate. The entire process blurred the line between saver and borrower. But then came the payments, small at first, but deceptively designed. 8. Tiny interest-only payments made the early years easier. Early building and loan mortgages weren't designed like today's fixed 30-year contracts. Families often began with years of almost interest-only payments. That meant the monthly bill felt light, maybe $5 or $10, manageable even for a mill worker earning $18 a week in the 1920s. But beneath the relief was a hidden truth. Those early payments barely touched the principal. This system gave households breathing room while they settled into home ownership. For newlyweds or immigrants just finding their financial footing, the small starting payments felt like a gift. Associations defended it as a way to prevent early defaults, because a lighter burden in the beginning meant families had time to stabilize. By 1929, Industry reports showed that nearly 60% of B&L mortgages followed this pattern, with principal repayment delayed until later years. It worked, but only for disciplined savers. If you didn't prepare for the bigger bills coming down the road, the mortgage could suddenly feel crushing. This rhythm of light early years, followed by steeper obligations, shaped how families budgeted, taught them to plan forward, and forced them to accept that home ownership was a long-term test of patience. And then came the twist, one giant final payment that could shake a household's nerves. 7. Giant balloon payoffs tested household discipline. A building and loan mortgage almost always ended with what borrowers dreaded most, the balloon payment. After years of modest interest installments, families suddenly faced one massive bill, sometimes $500, $1,000, or even $2,000 due in a single check. For context, that was equivalent to several years of wages for a factory hand in the 1920s. This looming deadline shaped how households thought about money. Parents took extra night shifts, mothers took in sewing, and children often handed over nickels from part-time jobs, all to ensure the balloon didn't sink the home. Historian records from Pennsylvania B&L associations note that many families began stockpiling in small increments years ahead, keeping secret jars or hidden envelopes labeled final. The balloon was a test of patience and foresight. Some families succeeded, paying it off with pride, often celebrating with a church supper or new curtains. Others stumbled and foreclosure followed, especially during the Depression. By 1933, an estimated half of B&L borrowers nationwide struggled to meet these balloon demands, which fueled the push for later reforms like long-term amortized loans. The balloon system was unforgiving, yet it trained households in relentless forward planning. But community wasn't just about money. It was about meetings that kept everyone honest. 6. Member meetings felt like town hall gatherings. Building and loan associations weren't run behind closed bank doors. They lived inside meeting halls, back rooms of churches, or rented office spaces where every member could walk in, sit down, and be heard. Once a month, sometimes once a week, dozens of families crowded into folding chairs to hear reports, cast votes, and track every penny. Minutes were read aloud, often naming those behind or ahead on payments. That kind of public accountability wasn't cruel. It was expected. Falling behind meant everyone else's savings were at risk, so transparency kept the group steady. In 1925, records from Philadelphia show that nearly 70% of associations required attendance at least quarterly. Some even fined members a dime for skipping meetings, reinforcing the seriousness of the collective effort. Loans were approved in real time, too. A mason might stand up, hat in hand, asking for $800 to finish his home addition. Neighbors voted yes or no right there, their decisions shaping the street they all lived on. It was banking mixed with community theater. These meetings forged trust and bound members together. And when someone faltered, that same room decided whether mercy or discipline would follow. Mercy came in the form of extensions, often quietly granted. 5. Extensions for hard times kept families in their homes. When a member lost his job at the mill, or a mother's laundry income dried up, a rigid bank would have foreclosed without hesitation. But in building and loan circles, hardship was debated face to face. Families could plead their case, and more often than not, extensions were granted. Records from Ohio associations in 1931 show that nearly 40% of loans received grace periods during the Depression years. Instead of seizing homes, the group voted to pause or restructure payments, sometimes for months. Neighbors understood that foreclosing on one family would ripple through the whole community, dragging down property values and morale alike. These extensions weren't handouts, they were survival tools. Some associations let interest accrue quietly. Others asked for token payments, even 50 cents a week, to show goodwill. Borrowers often repaid that mercy later in full, with gratitude that couldn't be measured in dollars. This spirit of flexibility kept thousands of households intact. It was the opposite of today's impersonal foreclosure process. It was intimate, transparent, and rooted in the idea that stability mattered more than penalties. Yet these associations weren't only merciful, they fiercely kept mortgages local, away from Wall Street's reach. 4. Mortgages stayed hometown affairs, not Wall Street deals. When families in the 1920s and early 1930s signed for a loan through their building and loan, the money didn't come from some faceless financial district. It came directly from the nickels, dimes, and dollars neighbors dropped into the passbook each week. That intimacy made mortgages a community bond, not a speculative product traded for profit. By 1929, over 12,000 local B&Ls operated nationwide, controlling nearly half of all residential mortgages in America. These weren't skyscraper banks. Many worked out of storefronts or converted living rooms. The funds never traveled far. They built homes on the very streets where the investors themselves lived. Because the money was local, borrowers had to be cautious. Overborrowing meant disappointing not a corporation, but the grocer, the tailor, and the blacksmith who trusted the system with their life savings. That proximity bred discipline. Defaults weren't statistics, they were personal betrayals. This structure insulated communities from Wall Street's boom and bust roller coaster, at least until the Depression's full force cracked even the strongest associations. But for decades, it meant mortgages felt tangible, real, and accountable. And every dollar raised, saved, or lost was spoken aloud in monthly reports for all to hear. Third, monthly reports were read aloud for all to hear. The lifeblood of a building and loan was transparency, and nothing proved it more than the monthly report. Once a month, members gathered, sometimes in a rented church hall, sometimes in the back of a general store, and listened as the secretary read aloud every dollar in and every dollar out. In 1930, with more than 11 million Americans tied to B&Ls, these reports carried enormous weight. Everyone knew who was late on payments, who had paid ahead, and how much money sat in reserve. Unlike today's private bank ledgers, these records weren't hidden. They were community property. It wasn't always comfortable. Families who fell behind had to sit quietly as their arrears were announced to neighbors. Yet this discomfort doubled as social pressure to stay current, preserving stability in the group. Others drew pride when their names came up as being ahead of schedule, almost like applause in numbers. This system created accountability so strong that delinquency rates in B&Ls often stayed below 3% compared to double-digit default rates in commercial banks during the same era. But when payments slipped too far, the group had another tool: hardship extensions, a safety net only neighbors could provide. 2. Building and loan groups competed with banks. and often won banks in the 1920s and 30s, treated mortgages like luxury products. They demanded huge down payments, often 40% to 50% of the house price, and loans rarely stretched beyond 5 to 10 years. That meant most working families couldn't even dream of ownership. Building and loan associations stepped into that gap with a completely different model. Instead of shutting doors, they opened them. Members pooled weekly deposits, and when enough capital stacked up, loans were issued to fellow members at fairer terms. While banks routinely charged interest rates north of 7%, many B&Ls hovered around 5% or even lower. For working families, that difference meant meat on the table. By 1929, more than 12,000 B&Ls operated across America, financing nearly half of all non-farm homes. In small towns, they outperformed banks outright. Mortgages approved faster, payments spread over longer periods, and policies tailored by people who knew each other by name. The Great Depression tested both systems. Banks failed by the thousands, wiping out depositors. Yet many B&Ls, though strained, survived by adapting, cutting dividends, granting grace to borrowers, and relying on community solidarity. That resilience flowed into the final truth. These loans weren't just business. They were intergenerational lifelines. 1. Community loans created stability across generations. For much of American history, home ownership wasn't secured through faceless institutions, but through neighbors pooling risk. A building and loan meant the butcher, the teacher, and the grocer were literally invested in your roof. Every dollar of your mortgage came from their stamped passbooks, so default wasn't just financial, it carried social weight. That collective accountability worked. By 1900, B&Ls had already financed nearly 2 million homes, spreading ownership into working-class families who banks ignored. Houses were modest, 2-story frames, clapboard siding, no frill designs, but they anchored families for generations. Census records show that home ownership rates rose steadily in towns with active B&Ls, sometimes 10 to 15% higher than neighboring counties without them. Stability wasn't just economic, it was cultural. Families who owned their homes passed down not only property, but also the habit of thrift, discipline, and civic involvement. Many of those houses still stand, built on the backs of weekly nickels and dimes. And while the 30-year mortgage eventually replaced share-based lending in the 1930s, the ethos of community financing lingered in credit unions and co-ops. The final irony? Wall Street later securitized mortgages for global profit, but the original system was deeply local, rooted in handshakes and stamped paper. Thanks for spending time uncovering this lost mortgage history with us. If you enjoyed the journey, subscribe for more forgotten financial stories. There's always another surprising chapter ahead, so stay curious, stay learning, and join us for the next untold tale.